I had been turned down for a position because my credit was lackluster. And the irony of being pushed away from something that I thought I wanted to do. And so here's one lesson that I learned from this, is that rejection is God's protection. I fell in love with sharing the principles behind credit because it was something that I personally, obviously, as you heard, struggled with in many ways. And I loved the aha face that people had when they heard me speak about credit. It is my belief that we are built to succeed, but we are being programmed to fail. One of the biggest things that I learned in one of my mentorships is half of the money that we win or lose in life is going to be done at the negotiation table. Hello everyone, Micah Smith here. I am here with another episode of Rebuild and Rise. And today I have quite a few things that I want to cover. And what I wanted to start off with today is I did a podcast with a friend of mine, and he's a loan originator, and he had a lot of really good credit questions. And so obviously that is what I specialize in. It's what I've been doing for the last 12 years. And so today I wanted to give you my top 10 questions that I get. And in fact, I probably have 20 questions. We'll probably do this in 2 segments. So I'm going to give you my top 10 questions that I get as far as my background, my history, myths and misconceptions in the credit industry. So I'm going to dive right in. So the first question I got was, what inspired you to get into the credit repair industry? So I actually was not inspired to get into the credit repair industry. I was recruited into the credit repair industry. And I was actually working in lending, and I got a call from a recruiter. He was recruiting for a big firm, and he called me, was telling me about an opportunity in the credit space. And now, mind you, I came from a background where I worked in the staffing industry for quite a few years. And for me, I knew the general procedures that would go into finding a good candidate for a company. And so myself, being as egotistical as I used to be at that young age, I was like, why in the world would you want me to work in the credit space? And very long story short, because I've told this before, I think I told this in episode number 1 as far as why I work in the credit space, but I finally listened to what it was that they were. I literally hung up on the recruiter like 4 times. And so he told me what the company did. And he's like, we don't want you for your background in finance. We understand you don't have a background in finance, but you have a background in sales. And you're going to be teaching as far as like how credit works. And I was like, oh, I understood that. And so very long story short, I accepted the position. But here's what happened. And this was very interesting to me. And this was actually something that I recently shared. I'm actually working on another project, which I'm not going to talk about right now, but I'm working on another big project. And something that recently just reoccurred to me was that I had been turned down for a position because my credit was lackluster. And the irony of being pushed away from something that I thought I wanted to do. So it was interesting because while I was in lending, I was looking for a different career path because it wasn't really one that suited me. It was very transactional. It was a business to business. I was doing these giant loans for businesses, and I really didn't love it. So I was looking for a new position, and so I was looking in the staffing industry, and because I thought I had wanted to go back to staffing. And so I get through all the interviews, and we get to the final interview, and they loved me. I loved them. I had a super successful career already in staffing. And the craziest thing was that I actually ended up getting turned down for the job because there was something on my credit report that made me look risky to them as an employer. And so here's one lesson that I learned from this, is that rejection is God's protection. This was not the path that God had for me long term. He's like, this is not part of your life anymore. This is not where I wanted you to go. So at the moment, it felt very devastating because this plan that I had wasn't working out. It wasn't materializing. And then interestingly enough, right, I was seeking after something else. And then lo and behold, I'm getting calls from recruiters pulling me in the direction that I was actually supposed to go. And I was hanging up on them and being obstinate and not listening. And then I finally ended up jumping into this career path, and God pulled me into it. It wasn't something that I even had wanted to jump into. I didn't even know it existed. And within about a month of working within this field, I realized very quickly it was a vocation. I fell in love with sharing the principles behind credit because it was something that I personally, obviously, as you heard, struggled with in many ways. And I loved the aha face that people had when they heard me speak about credit. It was so absolutely fulfilling for me. And to this day, the fulfillment that I get from solving people's problems and credit problems brings me immense satisfaction and joy because I know the savings on the back end and I know the freedom that people experience when they fix their credit score. So that's how I got started in the credit space. But I wanted to talk about how credit repair is different from credit counseling because that is a very big question that I get asked a lot. So, and in fact, we might even just do top 5 things on this podcast because I feel like there's a lot that we need to uncover just in 5 things. And again, we're going to break this up into multiple segments so that you can absorb as much as possible. So how credit repair differs from credit counseling, this is really important. So credit counseling, and the semantics do matter because on Google, credit repair companies can't list themselves as credit repair companies. They can only list themselves as credit counseling services. And there really is a vast difference. So these companies will say, oh, are you $10,000, $20,000, $30,000 in debt if you're going to qualify for our program? And so people will hop on this because debt is something when you have mounds and mounds and mounds of it, it's very, very scary. It's very intimidating. You oftentimes don't necessarily know what to do. And so all of a sudden you find yourself in a position where these programs sound very enticing. And how it works is this. They're going to tell you that you're going to stop paying all your bills. So this, of course, sounds incredibly enticing because you feel like this sense of relief, right? Like stop paying all of your bills and start paying us this monthly sum that we're going to agree on. And then we're going to take care of everything for you on the back end. Now, here's the problem with this. So there's a lot of fine print that people unfortunately just don't read. And when people are in a state of high emotion, panic, it's proven that the IQ goes down substantially. And so we're no longer thinking with a rational brain, we're thinking with an emotional brain. And these companies, unfortunately, they understand it, right? It is my belief that we are built to succeed, but we are being programmed to fail. And there's so much that I'm going to uncover with this topic and other segments that I'm going to do. But with this credit counseling, so what happens is, again, you stop paying your bills. So the moment you stop paying your bills, you stop paying your credit cards, you stop paying your installment loans, the credit score starts to plummet. So you're going to see that there's going to be a significant amount of backlash when this happens. And it's much more than what you could potentially ever expect. So you're now missing payment after payment after payment after payment. So the credit score is going down, 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 down. So in my classes that I teach, I say in the worst case scenario, what we have seen is if you have, let's say, an 850 credit score and you have one 30-day late on a credit card, your score could drop as high as much as 180 points. That's an insane drop. And it takes you a full 7 years to recover back to your 850 organically. Okay, so you have to understand, so the damage that you're doing is catastrophic. So you're missing payment after payment after payment. But here's the thing. So the only way that you can go and negotiate with a creditor a balance that is owed is when you start falling under hardship. And so when you start missing payments, that's the only way. If you are in positive standing, you've never missed a payment, you can negotiate interest, but you cannot negotiate the balance that is currently owed. You signed a contract, you signed an agreement. It is your job to uphold that agreement. And so you will not be able to negotiate it whatsoever. And so these companies know that when you start missing payment after payment after payment, now you have the ability to go in and potentially settle. But here's the problem that we see often. So someone's like, okay, well, what's going to happen to my credit score? They gloss over it and they're like, oh, you're going to recover in a couple of months. It's not a couple of months. I want to be clear on this. So missed payments, guys. You missed one payment, 1 30-day late. It's on your credit report for 7 years and does damage really for about 6.5, almost at full 7, right? So one missed payment, but you are missing multiple payments on multiple accounts. Now, what happens is a lot of times these accounts will get into a status, which is called a charge-off status. So a charge-off is essentially, right, the company no longer looks at your debt as an asset. They write it off and it's no longer an asset. Now it's a liability. So they write it off in taxes and either it's an internal collection or they might even sell it off to a third-party agency. So at this point, once it goes into that charge-off status, right, you might have lenders coming after you to try to collect on you. So what these companies do is they're going to say, okay, well, you know, if there's a certain account on there that maybe you didn't read the fine print, like American Express, for instance, they're not going to settle American Express, and people don't know that. So American Express, all of a sudden, they start getting these phone calls, and all of a sudden they go into judgment status, or they start getting sued, and they're like, oh, sure, no problem. We'll go ahead and we'll help you out with that with an extra fee that you incur to have one of their attorneys represent you. So there's all this behind the scenes stuff that is happening that you're just unaware of because, again, you're in this emotional state, so you're not thinking with your rational brain. And this is what drives me crazy about these industries that are dealing with people's finances, because it's a very emotional place to be. So what you're seeing is people are in these programs. So I will tell you, the amount of clients that come to us after they've been in these programs, they are at wit's end because they're like, I'm getting phone calls. Someone came to my door. I'm getting notices for being sued. I had no idea this was going to happen. My credit score is terrible. Nothing's happening. Nothing's moving. So this is why, is because it's going to take them, right? It's going to take time for the little bit of money that you're giving them every single month to build up in this escrow account that they put your money into in order for them to go and negotiate and settle on your behalf. So a lot of times these programs are going to be 3 years long, 3.5 years long, 4 years long. And so then by the time they're finished paying off all your debt, well, that's great. But here's what you failed to recognize. You have a middleman. They have to make money too. So not only are they paying off your debt, but now you've paid the middleman and now you've paid the price with your credit. Okay. Please go back to my episodes prior where I talk about the cost of credit, and we'll go into it a little bit more, but the cost of a low credit score is not a couple of dollars. It can be thousands a month. The average person in America is paying $1,400 a month in interest right now. Most of our clients in our program, because they have those subprime credit scores, are paying exorbitant amounts more than $1,400 a month in just interest because they look risky on paper. So unfortunately, the damage done is much longer than what you could ever imagine, right? So here's the picture, right? So I want you to picture this in your head. So you've got all this debt. All right, so you're trying to figure out how to take care of it. So now you've involved a middleman. So that middleman, now you've stopped paying your creditors. Now you're paying the middleman. Now you're putting all this money over here. You're letting the creditors just sit. These balances are getting bigger and bigger and bigger and bigger and bigger and bigger and bigger. This middleman, their goal is just to collect your money, pay off your debt. Doesn't matter what it is, if it makes sense to pay off, not to pay off, right? So they're paying everything, right, that's negative, which sometimes it makes sense to and sometimes it doesn't make sense to. I've had these agencies, I've had them pay off people's debt that was past the statute of limitations, which means the debt was no longer even legally collectible in their state. So now they're reactivating debt that was no longer legally collectible. I'm telling you, it's story after story after story that I could share with you as to why this was a bad fit for the individual that signed up for the program. But because the person who's signing up for this is unaware, and oftentimes the person signing you up doesn't even know the catastrophe that they're putting you into. They're just a sales agent that was instructed to read from a script, tell you what to do, and here's why, and they're making a commission off of your unfortune or your misfortune. And so here's what we need to make sure that people understand. There's a massive difference between credit repair and credit counseling. Credit repair, right? Everything we do is in an effort to preserve your credit score. Credit counseling, they're just focused on settling the debt and making as much profit off of you as possible. So, right. So you have to understand what you're signing up for. So once they take that money, once you have all of those accounts settled, right? So let's just say you have a bunch of charged off accounts with all these missed payments. Right? That stuff, again, stays for 7 years. So let's just say it goes into charge-off status, right? And let's say it gets to be 2 years old and then it finally gets paid off. When it finally gets paid off, it stays on the report an additional 7 years from data satisfaction. That satisfied charge-off does not get removed. You can't ever go to an original creditor and say, I'm going to do a pay to delete with this. They can't negotiate that, and neither can you. The only way it can be removed is based off of the factual misrepresentation on the credit report. There's many laws that govern the creditors as well as the bureaus, which is what we uphold all day, every day. So now we're going in and we're looking at how it's misrepresented on the credit report, how it's actually misreported on the credit report. And we're also going off of the fact, can they verify that it should be on the credit report? So there's all these little things that we're asking for and that we're forcing them to verify that it should stay on the credit report. But that additionally is going to take time, right? So it's this thing that compounds on itself, and it's years and years and years of damage. I think one of my favorite success stories that comes to mind in this scenario is we had someone who went through credit counseling, and they were maybe just a few months in. And so I looked at their credit report, and this person had a substantial amount of savings set aside to be able to settle their debt, but they thought that the credit counseling route was the way to go. And so I said, listen, here's what you're going to do. Most of the time, just FYI, you're not going to have a contract. If you do have a contract, you need to know if you have a contract, and you need to fulfill that contract. That's very important. Okay, so when you have a contract in place, you need to fulfill your obligations, and don't just stop something out of the blue, because that's how you get into trouble in the first place. So if you have a contract in place, fulfill it. If you don't, here are the steps that you're going to take. So you're simply just going to call up the company, whoever it is that you're in credit counseling with, and you're going to ask them to, you want to know essentially who they have some sort of an agreement with. So let's just say you defaulted on Discover. There's enough money in your escrow account to settle Discover. They made an agreement with Discover. You need to honor that agreement that was made with Discover. But let's just say that there's a few other credit cards like Capital One, maybe you have a Credit One, whatever. You have a couple other credit cards that there's no agreement with this third party. So what you're going to do is you're going to say, okay, the money that, right, we don't need to settle these accounts, I need that back. So they will give you the money back. And then what you're going to do is you're going to let them settle what they've already gotten to agreement. And then you're going to take that money and you're going to start calling these creditors on your own, and you're going to settle these accounts on your own, right? Because there's no difference between them settling and you're settling. People get really, really afraid of creditors. Just remember, you're just talking to people on the other end of the phone who essentially, right, it's just an account executive who essentially has been assigned to collect your debt. That's it. You're just talking to a human being on the other end of the phone. And so we instruct and we teach our clients how to do this. There's a few tricks that we like people to notate. So when you're settling your debt, you want to make sure that you wait until the end of the month. So the end of the month is the best time to settle out any sort of debts because, again, companies are trying to hit quota. So they're going to be much more likely to settle with you at the end of the month versus in the beginning. As well as you also want to note, so when you're negotiating, and always negotiate, you want to start low, right? And then you want to work your way up. So if you want to negotiate your debt, start low. And it's always good to give an exact number. So have a number written down that you can actually afford to pay. So let's just say you have a $10,000 balance and you're like, okay, well, I can afford to pay $1,992.22 because you've budgeted. That's your number. So be firm on that number and stick to that number. And then you can reach out to the person who owns your debt. So, say it's Capital One, you can reach out to them, talk to the collections department, and give them this very specific number. The first person you speak to is not going to be able to give you this exorbitant discount. So, you're going to kindly and say, thank you so much for your time, but can I speak to your manager? And the manager might be able to discount it significantly. Here's what you don't want to do. You don't want to get roped into these monthly payment plans because, again, you're paying more than what the debt is going to be worth. And when you make these payments on these accounts, you're reactivating it literally every single month, and you're not allowing the account to age. Accounts need to age to do less damage. So if you continue to make payment after payment after payment on these accounts that are in negative standing, again, you're never allowing them to age. So it's better to come up with one big payment that you can make all at once, or maybe break it into 2 or 3. That's much more ideal. You will save yourself an exorbitant amount of time, money, hassle, and then once it's satisfied, we as a company can work on trying to remove it based off of the laws that govern the creditors as well as the bureaus. Again, you're not going to be able to do a pay to delete with original creditors. They legally are not going to be allowed to do that according to the FCRA. They legally have an obligation to report what is fair and correct according to the FCRA. And that's literally what the executives are going to tell you that you speak to on the phone. So there is a massive difference between credit repair and credit counseling. And yes, semantics do matter. So if you find yourself in this exorbitant amount of debt that you are just overwhelmed by, right? We get a lot of people who come to our program who want to jump into credit repair. And so our firm has extremely high ethics and extremely high morals and standards. So everybody that comes into our company, we put them through rigorous testing to make sure that they actually fit within the moral compass that we have set up at Micah Abigail, my credit firm. And so if someone has this exorbitant amount of debt, whether it's current credit cards that are in positive standing, or let's just say you got a bunch of brand new credit cards that were recently just charged off, we're not going to take you on as a client because we're going to say, listen, you need to get to a point where you're more stable because these creditors are going to come after you. They're going to sue you. They're going to take you to court, and that's going to turn into a judgment. If you don't show up, it's called the default judgment. There's many types, but we're going to let them know, here's what you need to do. And sometimes we're going to say, hey, maybe bankruptcy is a better option for you. One thing that you don't want to necessarily discredit or discount is bankruptcy. Bankruptcy is not the end of the world. A lot of very successful people file for bankruptcy, and what that bankruptcy does, right, is it's going to act as a coverlet. So it's essentially, right, so the bankruptcy is going to let all the creditors know, hey, this person has filed for bankruptcy, and you're no longer going to be getting all these phone calls. So we never give clients advice on bankruptcy. We tell them, go speak to a bankruptcy attorney. So it's really, really important that as you're navigating through the very complex world of credit, just know your options. Bankruptcy is not the end of the world. It is a very viable option. We do not recommend credit counseling to anyone, ever, because there's nothing that they're doing that you can't do yourself. And if you were to do it yourself, not only would you save yourself time, but you're going to save yourself an exorbitant amount of money and an exorbitant amount of stress. So we want you to know what your options are. And sometimes credit repair is just a better fit. Credit repair, and so we'll tell you when you're a better fit for credit repair. And of course, we're looking at things like statute of limitations, like is this still legally collectible? Does this make sense for you to pay? And if it does, why? So we don't generally want our clients to touch things like, let's say, repossessions, because so much has usually been done wrong in the case of a repossession. So just make sure you understand that credit counseling and credit repair are vastly different. You want someone to look at your credit report with you, look at how everything reads, and then you're going to essentially get advice tailored to you in your specific situation. That's really, really important. So I really wanted to go over that in depth because I feel like where we're at right now in our country, the amount of debt that people are in, it's exorbitant. And we're actually seeing numbers on credit scores continue to fall and plummet as inflation continues to hurt people. We're seeing people continuously missing payments on car loans, mortgages, credit cards. So we're seeing people are really struggling right now. And so if you find that you are in an exorbitant amount of debt, I want you to explore your options, know what they are. I want you to know that you can negotiate your interest rates. That's a very viable option. We tell all of our clients, negotiate your interest rates with your credit card companies. That's something that people fail to realize that you can do. You can always negotiate interest rates. One of the biggest things that I learned in one of my mentorships is half of the money that we win or lose in life is going to be done at the negotiation table. Everything is negotiable. Everyone has a price. I'm telling you, everything is negotiable. So learn how to negotiate. There are some amazing, like even YouTube videos, learning how to negotiate. It's a really important thing that everybody learns how to do. I wanted to also give some of the most common misconceptions about credit repair. And one of the biggest misconceptions about credit repair, and this is what we see in our program all of the time. People think that just because you're in credit repair, your scores are automatically just going to be going up. So credit repair, when we talk about credit repair and we talk about this with our clients, this is a two-way street. We cannot do everything for you. We cannot pay your bills for you. We cannot manage your positive credit for you. One of the biggest components to your credit score is going to be how you manage your positive credit. So if you are mismanaging your credit cards, if your utilization is continuing to soar through the roof while you are in our program, I have seen people have all of their derogatories removed and then still stay at a 590 credit score. And once all of their credit card balances are now at 6% utilization or less. So I had a client just like that. She's actually a friend of mine. And we removed all of the negatives from her credit report and her scores were still at a 590. She was so frustrated. And so I'm like, you have to pay down your balances. If you don't pay down your balances, then your scores will not move. So she took our advice. She paid down all of her balances. Her scores went to over 800. She about died out of happiness. And it was a great thing for her to see and experience, but people don't realize. And I have had people tell me that you were so good at sales. I still remember there was a guy, we had removed, I think like 20 negative items from his credit report and he was doing phenomenally in our repair, but his scores just weren't moving. And I was telling him, I'm like, listen, you have to make sure that you pay down the balances on the credit cards because they're not going to move. And I was listing all the items that were being removed from his credit report. He's like, you're so good at sales. And I'm like, I'm not good at sales. I'm like, I know how credit works. I know what moves the needle. People always ask me, what is your success rate? I'm like, it's 100%. I know how to move the needle. I can make your scores move. I cannot guarantee deletions. I cannot guarantee, how quickly the deletions are going to come off your credit report or when, but I can guarantee you I can get your scores to move. And that is one thing that I am exceptional at. And so when people take our advice and they follow our roadmap, they are going to be successful. There are thousands and thousands and thousands and thousands of success stories that I have had over the years, people taking our advice and then finding themselves in a much better position. And it's those ones that we love seeing in our program because, right, again, I think, and I talked about it in one of my old podcasts, like we're constantly qualifying people for our program. Right now, I'm going through some workshops with my COO, and we're talking about the type of people that we want in our program. We want people who are accountable for their actions. We don't want people in our program who are not accountable. I had a person in our program that ended up costing me more time, more money than any client we've ever had because they refused to take accountability. And they were seeing so much success in our program. And while they were in our program, they missed brand new payments on one of their installment loans. And they screamed up and were demanding all this attention and demanding all this time and all of these things out of our company that we just don't have the resources. Like they wanted 3 hours of our time every single day just to basically be like a glorified therapist and telling us that we were the ones in the wrong. And I'm going to tell you, it was really disappointing because like on black and white, right, we're showing this individual, listen, this is why your scores dropped while you were in our program. You can't miss a bunch of brand new payments and expect your score to be higher than when you started with us. It doesn't work that way. Anything new is going to outweigh anything old. So we had her moving in the right direction and all of a sudden, again, and so she just refused to take accountability and just, it was a very, very stressful situation for everyone involved, including my team. And so it's one of those things where we will disqualify someone from our program and say, listen, we're going to part ways now because if there's a lack of accountability, right, there's no way that we can work together. right? We need people who can take accountability because we'll help you get back on track. We'll help you see success, and it's going to be a little bit longer of a road for you, but we'll help you get back on track. But we can't help someone who refuses to take accountability for missing payments and not doing what is required of them to be successful. One of the biggest things that we see is, again, just people not seeing and being receptive to education. And that's one of our biggest values, is education. And that's how I built my company from the last 12 years, is teaching all over the country as far as how credit works. And so understand, one of the biggest misconceptions people have is just because you're in our program, it doesn't exempt you from having a score dip. Like, I can't protect you from payments that you miss hitting your credit report. I can't protect you from new collections hitting your credit report. I can't protect you from the damage that's going to be done when you max out your credit cards or go over the limit on your credit cards. I was just reviewing a file with my team the other day, and this person's credit score dipped, and I had a new team member that had just started, and so I was teaching them how to do updates with our partners. And so they had about 18 items removed from their credit report, but they went over the limit on all of their credit cards. And so because of that, their scores dipped, even though they were seeing an exorbitant amount of negative coming off of the credit report. And so that's one of the biggest misconceptions I think that people have. And a lot of people too think that, oh, if I pay everything off, then, and I'm talking about negative items. So people have this misconception, if I pay off all my negative items, my scores are going to go through the roof. And it's usually the exact opposite. So again, if you have a collection on the credit report, all the rules change versus, say, like your credit cards, right? You pay them down, your score is going to go up. But if you have something in collections, right, usually what happens is you're now going to restart the clock. And so the DLA is going to be brand new. That's what we call it, as a date of lost activity. It's going to be brand new. And now the negative item is going to stay on the report another 7 years, and it's going to do more damage. So you're going to see the scores sometimes drop 60, 70, 80, 90, 100 points when you pay off all these negative items again. And now it stays another 7 years from data satisfaction, doing damage that entire time. So people oftentimes are like, oh, well, I'm going to pay all this stuff off and my score is going to improve. I don't need you. I think another misconception, we specialize in the mortgage industry. And so because we specialize in the mortgage industry, oftentimes we're talking to our loan originators. They're like, oh, we do credit repair. I'm like, oh, you mean you use a simulator? Paying down your credit cards is not credit repair. Credit repair is helping people remove negative items from the credit report, and that takes a lot of time. So essentially, people have this giant misconception, right, that using a simulator is credit repair. That's not credit repair. That's just paying down your balances, right? So it's really important that you understand what is credit repair and what's not credit repair. So you as a client need to be very informed as far as, right, what your score is capable of doing, right, by paying down balances, and what it's capable of doing with credit repair. Sometimes people need both, sometimes people just need one. And so we help people navigate through that along with their partners. So we've got amazing partners that we work with in the mortgage industries and the real estate industries. And so we help people understand, okay, this is, like, we get clients all the time that just need to pay down their balances. We're not going to enroll you into our program and charge you just to tell you to pay down your balances, right? That's not credit repair. Credit repair is the genuine removal of negative items that are in violation of the laws that govern the bureaus and the creditors. So I want to make sure that you understand that credit repair, right, is something that is done using laws. And I think that leads me right into the next question, which is, how long does credit repair take? Credit repair takes a different amount of time for everyone involved. So credit repair, the genuine removal of negative items from the credit report, we see so many different numbers for so many different people. So it just depends on the file. And I think this is probably one of the hardest things for us to explain to people. So we're always trying to set realistic expectations. And so this is actually, I'm going to put two questions together in one, which is, what to be wary of when you're searching for credit repair companies. So what we're often seeing, and this actually drives me bonkers. So we're seeing people on, like, I saw a video the other day on TikTok, and this guy was like, I can wipe out student loan debt. I can do a full credit sweep on your credit report. I can do this, I can do that. And they gave a time frame, and they gave a promise that they can remove all these things and just wipe it out, and that you're no longer legally liable for it. And that is a violation of every law under the sun that credit repair is supposed to be governed by. You cannot give people false expectations as far as when someone is going to see a certain success or a number or a type of deletion. You cannot promise those things. It's illegal. And so when it comes to timeframes, we don't ever give people a definitive timeframe because legally you're not allowed to. But I can tell you this. So one round of investigations, so when we're going after the creditors and we're going after the bureaus, there's a legal time frame that they have to investigate a file. So when we're going after a file, right, so we go and we send out a list of investigations to the credit bureaus. So when we go to the credit bureaus, right, there's a certain time frame that they have to respond. So it goes to the bureaus go to the creditor responds back to the bureau responds back to the client. And so that whole process is really only supposed to take 30 days from the moment that it hits the bureau's hands. So, but oftentimes we're seeing it takes a little bit longer. So anywhere between 30 to 60 days, oftentimes we see to complete a full investigation, but we legally can send more work after, right, someone has been with us for 30 days. So the bureaus will get another round of investigations from us after 30 days has passed because we legally are allowed to continue to pursue and ask for more information on these items every 30 days. So we're seeing a lot of people, sometimes they'll see crazy movement in, the first 30 to 45 days. Some people, the first couple of months. We'll see people with us in 1 month. We have people who will go up 200 points in 1 month. I've had 400s go to 700s in 1 month, but I've also had people go from 400 to 700 in a year and a half. It just depends on how the creditors and the bureaus respond to our investigations. So here's what people don't realize is that credit repair, there's no guarantee. You can't guarantee someone's going to just get all of these removals because the creditor and the bureaus have a legal right to respond. They have a legal right to defend themselves and say, no, this is why this is supposed to be on the credit report. And then they're allowed to provide documentation and say, here's why this should be here, right? They have that legal right to respond and keep it on there. And so, but we also have a legal right to rebuttal and say, well, here's why it shouldn't be on here. Again, it's not about, did you do it? It's about, can they prove it? Is it reported accurately? That's really how it works. And there used to be a saying that we would always talk about back in the day when O.J. Simpson was a big case. We're like, if the glove doesn't fit, you must acquit. And it was a bad joke, but it was an ongoing joke as to how credit repair worked because it really did come down to the finite details as to what couldn't be actually proven. We're looking for substantial documentation and evidence that this is supposed to be on the credit report, and here's why. So one of the biggest things, and I teach this when we do all of our trainings, when we're looking at credit reports, we're not just looking at negative items. It's not like, so you as a client or as a partner of ours, you're looking at negative items. And then when I start looking at the report, I'm looking at violations. There's a big difference as far as like how a person who is not in credit is going to see a credit report versus how someone who is in credit is going to see a credit report. We see violations, you see negatives. We see potential removals, you see negatives. Oh, something I did, we see something that potentially can't be proven. So there's a big difference as far as, right, how we look at it versus somebody else might look at it. So those are the 5 things that I wanted to cover with you today in regards to credit and some of the biggest questions that we get asked in our industry. And again, I'm going to break this up into multiple segments because there's so much to our industry. It goes so deep and so wide. And so with that being said, guys, thank you so much for listening. If this provided immense value to you, please like and subscribe, and please share with someone that you know is struggling with maybe credit or their finances. We know how many people are out there that are struggling with their credit and their finance, so please share this with someone that you know.